So we've got Florida Man, we've got Gilbert, we've got hopefully all of this technology is working. The technology is all over the place. Buenos dias, Pablo. ¿Cómo estás? Bien? Fantástico. Buenos dias, buenas noches, buenas tardes. All right. Let's dig into it. Letting everybody settle in. It's warm and it's free. Commander Cody, Bill Lucas is here. Mike Gavin is here. Jason Byrne is here. Bill Frank joined us. Bill Frank, that's a name. That's a name in Baltimore. That name means something. Billy Frank. Guy will build you a deck and then drink 2 or 3 Grand Marniers. All right. Good morning. So it's Thursday. It's June 11th. I don't know what happened on June 11th, but we're getting a little bit of a bounce this morning after a couple of brutal days. Nothing terribly shocking, but as we look right now, futures currently up about 0.6%. Nothing too exciting, but this is all about levels. We'll talk about levels. Levels matter. Russell's at 2872, NASDAQ at 28,860, and the Dow is back above 50,000. Crude oil dipping a little bit, gold pushing down to that 4,100 level. The line in the sand on the U.S. dollar is really what matters right now. And if we hop over to our momentum readings, we're going to make a couple of updates here in the next 24 hours. But as you can see, it looks green. Okay. But that cap is minus 30. That's what matters. So what we're seeing is a relatively sizable sell-off in those crowded Mag 7 single leverage stocks with a lot of ETFs tied to them, particularly double, triple leveraged single stocks, which is now a thing for some reason. NASDAQ market cap telling us the same thing. Russell is more or less flat. Rotation into healthcare, real estate, financials, and consumer defensive. A couple of important things that have come up in the last, 2 days has been the fact that the banks, the Wall Street banks, are now starting to warn about duration. That's hi. I wrote about that in April, so I'm 2 months early. I apologize. We'll dig into that. Thanks for joining. Ed's here from New Jersey. Tom has finally made it. That's good. He gets his card. I forgot which one it was. Paul Skeen's All-Star card. I got you, bud. You got to just send me a note. We will mail it to you. I've even got nice cardboard envelopes that I can put the card in. It's going to be great. You're going to love it. All right. So Russell, core thing, screamers, crashers, Best Buy continuing its breakout. Don't tell me I didn't tell you about Best Buy the other day. What is happening in our world that Best Buy is just cranking higher? 75.80 right now on Best Buy. Other names, Humana's been on this list for a couple of days. Really not a lot of breakout names, and I mean like big moves. But you see like J.M. Smucker, after a relatively weak couple of months, has pulled out. Intuit, Albemarle, they're all still here. Newmont, the mining stocks are breaking down. GE Vernova, which is one of the great stocks. It's just under pressure. The whole energy base is under pressure right now in the AI trade. And I talk about the constraint constantly. Okay, I'm just going to point out, this is going to set up for a hell of a buying opportunity for the long term. So look for names like GE Vernova, Constellation Energy. Look and see where they get into oversold territory, and then start to dollar average into some of these names for the long term. Constellation's one of my faves. NRG Energy. Again, this is, people ask, like, wow, you're bullish on this. Now it's selling off. What do I do? Okay, look, this is just how markets work. Okay, so the long-term focus on utilities remains the same. It's just that we are going through momentum events, forced selling events, risk off events. And as I've tried to explain time and time again, this is not the market from the 1980s and 1990s where you sit down and you go, oh, I think I'll own this for the next 20 years. Prices are more volatile. Things are a changing. And it's not good to see Amazon on this list. I'm just going to tell you that. That is bearish because, once again, we start to see the mega cap names get onto this list. Very problematic. We look at FinViz and we do the poor man's analysis real quick just so that you can see it. If you, GarrettBaldwin.com goes down, if I say go to New York and you can't find me for 3 days, which is entirely possible at 12 o'clock this afternoon, then you can always just follow S&P 500 numbers. You can look at the technicals. You can go beta 1 to 2. Once again, descriptive, S&P 500, technicals, beta 1 to 2. You look at performance up on the month, and then you go to a custom view and you do up on the week. This is poor man's momentum. This is just, I'm going to analyze flows over a 5-day period. Stocks need to be going up on a month because we want to see an ascension in the equity prices over a 20-day period. So 5-day, 20-day, plus beta elevated. We only have 2 stocks. Best Buy, which once again, you know what? I may single-handedly be the reason Best Buy stock is up. I spent another $97 there yesterday buying a new computer charger. The week before that, I had to get my computer fixed. I am why, but if I'm, maybe time to short it, I have no more things that I need to buy from Best Buy, including baseball cards. All right, on the other side of this, let's go to the downside. That is minus 5% down on the month. So we had 2 stocks positive. We have 46 breaking down. And let's go by market capitalization. All right. Apple, Microsoft, Amazon, Broadcom, Meta. Okay. We are clearly witnessing a risk-off event and a significant unwinding of leverage because, once again, these are the every buyer stocks. These are the things that different funds look at and say, I've got a lot of money. I can't buy $10 billion of Constellation because if I do, that is going to end up leading to me having to file multiple filings with the SEC. But I can sneak $10 billion into Amazon. That's where we operate. We have so much cash sloshing around. The money's got to go somewhere, and it ends up in a lot of these big mega cap names. You see Palantir on this list, Oracle on this list, Tesla on this list. This is a risk-off event, and it is clearly evident in our good old friend, the FNGD. The FNGD has broken above its 20-day moving average. We have a crossover, the 8 and the 20. But let's go and look at the real levered ETN, and that is the FNGU. So this is the other side of the FNGD. This is the leveraged positive ETN, and this is legitimately showing us in real time deleveraging. You can see 36 to 25. I'm not telling you to buy it, but what I am telling you to do is pay very close attention to all of those lines on the screen. Do you see it? Do you see that gap between the blue line and the red line? That is the 8-day and the 20-day. You see how all of a sudden that just erased? Then magically the line from the 20 to the 50 pops up and we just go from one to the next. And then the next day, 2 days later, we drop under that line, pop back up above, but we hit the 100-day and then we sell back off and now we hover. What's the next level? 100-day. 200-day, and then who knows? But this is mechanical. This is a good representation of what I argue markets have become. Just a consistent process of computers talking to one another, forced selling when they are forced to sell, forced buying when they are forced to buy, and we are but meat with eyes. Okay? So, as we assess this and as we look at it, gold miners bullish percent. Okay, we'll talk about gold in a second. All right. So the big story, the big thing that I want you to focus on right now. Again, insider buying to selling is a joke. Nobody's buying. Cap weight's still bleeding. The real story right now is liquidity. And this is probably the most complex thing that I've ever had to try to learn. But I'm going to point this out. The fear right now is global. It's not just here in the US. And I have said you got to pay attention to Japan. Now we've got to pay more attention to South Korea, which I didn't have that on my bingo card a year ago, but it makes a lot of sense when you understand what I'm about to talk about. The Korean won is at the lowest level that we have seen since 2008. We have not seen this much fear in emerging markets since the bottom of the Liberation Day panic. So that was April 2025. Now it is at levels that demand attention. And what is happening, which is problematic, again, this goes back to the fact that a lot of problems don't start in the equity market, they start in the Forex market. And more, because so many nations are beholden to policy decisions by the Federal Reserve and the Bank of Japan. Again, the Bank for International Settlements has written about this for 2 years. Nobody reads it, but they tell you, they admit it. It's all there. I write about it in Me and the Money Printer. South Korea's volatility levels and the broad emerging market volatility is moving in lockstep with U.S. technology stocks, which means that emerging market stocks are now acting more like AI than what historically has been, as I viewed, oil and other commodities. Asian quote unquote AI mania has rewired the correlation completely, and a risk off emerging market tape is the same trade as an unwind of US tech, just with more quote convexity. Now, because I said convexity, that means you need to find a bar today and have a drink. That is not a term that I like to pull off very often. But on the liquidity side, liquidity in the market, capital flow has disappeared. Now, that could be tied to what's going on with SpaceX, but it also is likely tied to what is happening with central banks. This is the most important thing that I will tell you today. The top of the book, S&P Futures Depth, has hit the lowest level since the height of the Liberation Trade crisis, roughly the first percentile on a 1-year look back. So when the book is that thin, the same order moves the market far more than usual, which means because there's not a lot of capital, and the question is, where's the buying money coming from? It ain't there. So the systematic crowd that's loaded and has been loaded for the better part of 2.5 months is now one nudge from selling. And if we break another key moving average, they have to sell even more. The trend following community right now is carrying a little bit more than $50 billion in long equities, and it is just 1% from another selling threshold. And there is a massive skew to the downside if the selling starts. How big? About 20 to 1. So combine thin liquidity, available capital, with mechanical sellers, and you get an extremely fragile market that the macro desks on Wall Street have been hammering for a couple of days. One group just came out and said that we put in the 99th percentile eight-week move. First time that we've flagged that since 1980. And that's the type of thing that lines up for a massive, violent mean reversion, which means all of the gains that we saw could be wiped out pretty quickly. The key thing to keep in mind here is that this is all mechanical. Okay. It is better. Eric, you can do whatever you want to do with your EMA. I have just historically used the 820. Some people use the 521. Some people use the 618. To be honest with you, I don't think it matters. I don't know what more traders use. I just use what I am trained on. I used to take a lot of crap from somebody who would tell me, why are you using TradingView? You have to use a different platform. And I would say, I was trained on this. I don't have the time or energy to try to ride a different bike, right? So if you are used to something and it works for you, do that, right? Guy walks into a ER. can't walk. ER doctor says, "What are you doing for pain?" Says, "I'm drinking a bottle of wine, taking 800 milligrams of Motrin." And the ER doctor looks him straight in the eye and says, "Keep doing that." That's a true story. All right. Equal weight treats every stock the same. Keep this in mind. That's important to note. On that basis, the broad market is narrowly positive. The cap weight is the giants like Nvidia and Google, and the money is leaking out there. When the biggest names in the market start to bleed, it sits on the whole index like an anvil, and it will take more than a few green mornings for that to stabilize. You could see the damage right now in what is happening with the Round Hill, the MAGs. So MAGS is our Magnificent 7 ETF. That is a significant unwind. But if you look at the S&P 500 equal weight, it's holding above its 20. It's holding above its 20. And that's positive. It's also positive to see that despite the fact that the FNGD is breaking out, that the banking stocks are still holding up, right? So the triple bear ETF on the financials is actually down, which means the BNKU, the banking stocks, are still elevated. This is telling me right now that there is not a repo event happening right now, and that the markets, for the most part, are still holding up in terms of concerns around Japan and other potential, impacts in terms of bonds. This can go the wrong way relatively quickly. But for right now, you see the selling pressure is happening at the top. And also we are seeing clear rotations into things like defensive, real estate, healthcare, and financials. That's good. That's healthy. That's what we want to see. But the VIX is riding a fractal higher. It is not a backstop where you chase. You want to watch and you don't want to reach. And when VIX is over 20, this again is that reminder. What do I not want to own? What should get rid of? There doesn't seem to be a cavalry coming anytime soon. And the US dollar continues to strengthen. And we'll talk a little bit about that. That is becoming a very crowded trade on Wall Street. This could be one of the more crowded trades of the second half of the year is a long dollar. And we'll talk a little bit about the UUP and how that matters. So, core thing that I want to just highlight again is a lot of this market right now where we operate, it's very mechanical. And it's going to require some sort of policy signal for the market to find its bearings, particularly those top level names. Well, fortunately enough, you have a signal coming next week. The Federal Reserve will meet on Tuesday and Wednesday. And I will note that in the next couple of days, it does remain a strong time to be trading volume weighted average price. And of course, as you lean into that Tuesday, Wednesday period, look for bias to the upside on Tuesday and Wednesday, and then the potential for a continuation of selling into Wednesday, Thursday, Friday, which is where we get into Third Friday and, of course, triple witching. Now, this is actually, you might remember this. In April, I released that report, The Hedge of Tomorrow 2, and in it, I laid out a case for our current financial cycle. I cited Michael Howe. I talked about a lot of the different other people who were speaking about the concerns around liquidity, and the argument was the financial cycle is heading in the wrong direction. So it meant that investors are better off maintaining cash in negative momentum periods and avoiding long-term bond duration, which means 10-year, 20-year, 30-year bonds, and we've just hit 5% again on the 30-year side. 10-year bond is moving higher. Wall Street's now starting to come out around this now. And we're seeing more and more people say, stay in short duration. Fidelity did it first. Then we've seen a couple of like banks, sell side banks now start to make this argument. Let your cash earn, SGov, BIL, but they're saying avoid the TLT. They're saying avoid the TLT because it's where the long duration is. That goes the wrong direction. The long end remains the risk in this market, not the trade. So don't be a hero in long treasuries while real rates are moving higher. And that's the deeper concern. We look at our screeners right now. CNC, which we first flagged on May 7th, remains at the top of our triples list. We're up about 20% since highlighting that. It's still riding as cheap. What I like about that name is that it's dug in its way out of a hole since it fell into last year. And again, it climbed back above the level where you would normally expect a rug pull. So you could consider selling a spread down at the 55 or 50 level. Just keep in mind it is overbought on the RSI right now. Bitcoin and gold. Okay, so I got a question about that. The selling we're seeing across the market in assets like Bitcoin and gold is like a margin call at this stage. So don't be surprised if these things are getting a bounce once we get the all clear out of these central banks. China added, but again, we are seeing continued pressure here. Selling creates selling. Gold's down around 4,800. I was a buyer at 4,250, but right now I have a very specific amount of gold that I own out of my full portfolio and silver as well. It's about 12%. So my rebalancing likely has to change, which means I have to be a buyer at this point. Silver hitting 63. This can get pretty gnarly pretty quickly. We're under our 200-day moving average on silver. And once again, this is a reminder that a lot of that silver buying was AI driven and highly mechanical. And the deeper concern that I do have around this market is that the AI trade may actually follow silver lower. That's to be discussed at a later point. The S&P 500 highs from June 4th is where we will be testing. The line in the sand for this market remains that 7,400 level. That is where that breakdown can be pretty clear. We could see another pop back up to that level and then another rollover. But again, we tested 73.95. We rolled right back over, and 2 to 3% days, they may be the norm for the next week and a half, which is unusual for us. But because of the amount of noise and because of the positioning ahead of the BOJ and the Fed next week, we're probably going to chop until we get through both of these. So relief usually will come, not after the Fed, but after the Bank of Japan makes a decision. Key headlines that we want to focus on. Remember, 10 years at 4.5%. 4.5% is a key line in the sand. Core question always remains, where does the market operate in these rate environments? 4.5%, I believe, historically since 2022. The median return for the week for the S&P 500 is somewhere around minus 0.1. When you get above 4.75, that's where you start to look at those 2% moves. A hot CPI means Mideast tensions. Again, yields are steady. XLE remains an interesting trade to the upside. Bond traders are holding the Fed hikes by December, even after that softer core CPI. Swaps are fully pricing a year-end move. And it's going to be pretty interesting next week because, again, we lost Mirren on the board at the Fed. So that means anyone who was really dovish is gone. That now puts the people who were very hawkish into the narrative, and we'll see how Warsh behaves. But for the most part, it's going to likely lean hawkish. But again, it seems that the market is pricing that in. Oracle, nope. This did not go well. Beat Q4, but missed on cloud. It plans another $40 billion raise for data centers. Keep an eye on the credit default swaps on Oracle. Shares are down 10%. America's car mart plunged to a 1992 low. We are scrambling for rescue funds before a Friday deadline around that name. JP Morgan saying that May CPI is likely the inflation peak, expects the Fed to hold at the meeting. Congratulations, you are with the other 99% of the market that is not calling for a rate hike in June. And PIMCO sees a default cycle returning on the AI build-out strain, favors an intermediate 5 to 10 year over the shorter long. Key thing to keep in mind when it comes to the AI build-out strain, what PIMCO is saying, they're probably really early on this because a lot of this debt is relatively new, 6 to 12 months. Those defaults are likely not going to come for another 12 to 18 months. And that's one of the games that we play. We end up in an environment where all of a sudden Wall Street starts questioning the stability of debt within an ecosystem. but the call is very early and it ends up on the front page of Barron's. It doesn't happen within the next 6 weeks. It goes away for like 9 months. And then all of a sudden, something happens. That's exactly what happened with private credit. It's exactly what happened with private credit. Private credit did not, private credit concerns started to emerge last summer. It went into the fall. We saw tricolor, but that was really like one of the small things. All of the redemption gates, they didn't come till this year. So just keep this in mind. That's an early warning. I firmly agree with that. That's going to come at some point, but it ain't coming today. So just recognize that you're in an environment where something is being thrown out there. Don't just run away from the AI build out simply because PIMCO warned about something. We would be worried about that from a momentum perspective, probably somewhere around October of 2027. All right. Cool. What else we got? Oh, NEG cap weight negative, Russell. So again, we're negative on our cap weight trend on the S&P 500. The Russell's hanging out. 7,400's the line in the sand. Wednesday selling hit everything, and again, that's where these little tiny pops come. Keep an eye on those key moving averages as we move forward. Shadow of Japan is pretty much everything. Again, if you don't remember this, Bank of Japan kept interest rates low for decades. Now they're raising interest rates. A lot of capital out of Japan started there. This became what was known as the carry trade, where you could borrow cheap in yen, convert to dollars, and then go invest abroad. This started to unwind in August of 2024. And everybody has been warning about it since. What really comes down to at this point for next week with Japan is, where are the hedge funds positioned for this? So what we have to do tomorrow is look at the commitment of traders report. We'll see where everybody is positioned on the yen for Tuesday, which would have been 2 days ago. And if people are positioned incorrectly and the Bank of Japan surprises everybody with something as absurd as a 50 basis point hike, or forecasts that they're going to raise rates even higher than the expected 1.25, then that positioning can lead to a significant unwind. And that's where the funds get trapped. And that's what leads to a cascading effect. Remember, back then when all of that started, that was an intervention in the Japanese currency markets in July of 2024. We had a negative momentum event on August 1st, 2024. And then 4 days later, the Nikkei crashed. It fell 12%, worst downturn since 1987. And then the U.S. markets lost roughly 3% that day as well. It all comes down to the positioning. So we'll walk through that a little bit. Just FYI, I am heading to New York today. I have a junket that I have to do tomorrow. I will be doing the show from a hotel tomorrow at 8:30. And then I'm going to be on the NYSE floor 12:30 for a little while, but they do have restrictions on camera equipment. But I'll write about it. All right. So last thing, again, just keep in mind, emerging markets are really the deeper concern right now, particularly Korea and Taiwan. The book is thin. There's not a lot of liquidity. A lot of capital is being sucked up by the SpaceX side. Oracle missed. That's another warning. And again, this is just going to be about levels and just being patient and recognizing this market's a lot more dangerous than people are letting on. And as I continue to argue, it has little to do with earnings. It has everything to do with the mechanical nature of this market. We saw an explosion of stocks linked to single stock ETFs, leveraged side on individual sectors. The SOXL went from 50 to 250. Now it's pulling back. This is mechanical. This is forced selling. And it also is, unfortunately, a bastardization of the financial markets, because once again, this is not about earnings. This is not about owning businesses. This is about pure momentum. And that's what we do. And we continue to showcase how this continues to happen in a world of increased financialization. So that's where we operate. All right. So real quick, I got 5 minutes. Even as choke points don't need to carry energy names like CEG for the next 20 years. I think the problem, unfortunately, is that everything is being priced in AI. from a mechanical side. So, Constellation selling off, I want to pay very close attention to where it might get oversold on RSI and MFI. We're getting there with CEG. We're not quite there on the RSI. We are there on the MFI. So, what we want to look for on CEG is, of course, to look for a crossover on this MACD. There is ample upside. And again, narrative shift on a dime. Remember, the average stock is held for like 6 months now. It used to be 10, 15 years. It's just the mechanical nature of these markets. It's frustrating because a lot of people view it as this long-term wealth machine. And what it's really turning into is a short-term wealth machine where timing is more important than ever. And for anybody who says that timing is not possible in the market, I invite them to look at the SOXL when we turn positive on our momentum signal on April 7th. Okay, good talk. All right, meet with eyes and still cannot see. Yes. All right. How do I measure the book depth? That is done not by me. That is done by the broker dealers in New York. And I will gladly write an article about that. If I try to do it right now, after the emotions that I had last night, screaming at my television in front of my wife and child during that Knicks game, I am afraid my voice will give out and I will not be able to do my 9:20 to 10 o'clock. But yeah, I'll write it up. It's easier to do that. I'm trained on Thinkorswim, and I'm now slowly in the free version of TradingView. We should have a video on how to set up VWAP, Robert, on Thinkorswim. If there isn't one if we don't have one, I will do it live here when I get back. I'll do it Monday or Tuesday. It's a little bit more complex, but it's actually, once you have it set, you're in good shape. So I can walk you through that. Gold has nowhere to go but down. Fine. Cool. No, I'm not ringing the NYSE bell. Do you buy more Mag 7 when they become oversold? No. What you look for in this environment is, let me walk you through this. So we're almost oversold here, right? What I prefer is you do a couple of things. So when you get to oversold, RSI, MFI, both, if you get it, both oversold. So that's where your blue lines are going to be. That's where you can speculate. But one of the things that I like to do, and a lot of people will say, well, that's kind of a different way to approach it. If NVIDIA gets oversold, right? What I'll do is use the higher volatility. I'll look at the implied volatility. Remember, I just did the 6 rules for negative momentum. When momentum gets negative, when the SPY and the S&P 500 get oversold, and they will, right? Because that's usually where the bond market is screaming at everybody. What I'll do is I'll look at the names like NVIDIA or Amazon or Apple or whoever it is. And if they are oversold and their implied volatility rank is elevated, and I'm talking 40, 50, 60, that's where I'm going to sell spreads to the downside under a key moving average. So what I'm looking to do is either take possession of the stock, maybe 15 to 20% below where it is now. And I'm talking like capitulation levels at that point. But if the stock does bounce back, the value of the spread that I have sold goes down as well. And then I can buy it back. So what I can look for is a possibility of making 20, 30% in a week and a half if it bounces back. And if the stock just hovers at a moving average, okay. And if I have to buy it at a lower level, fine. So it's just about recognizing where you sit at any given moment. I cannot export this stuff, Thomas. I can't. I can't export that data right now. I have an agreement with not data providers, but I don't want to test a relationship that I have right now, and where we originate our data set from, which it's not the individual data points. We have a third party data provider, and I don't know, and at the moment we can't export stuff. I'm just going to be transparent about it. Once we get permission on that, that's fine. But there's a couple of different places where data points come from, and those numbers of theirs are, it's like F score, right? F score that we pull from is from one specific place. It's their F score. So if I'm allowing the exporting of that number, that creates some problems. I don't want to test anything. Okay. All right. Cool. Brad's got a script. Good. We're good. All right. I got to jump. I got to be somewhere in 15 minutes, and I will be in New York later today. If you need anything, just reach out. I will be online as I always am. I hope you have a great trading day and a great investing day. And we're going to start to build a list because I'm looking for this market to start to spasm a little bit. We're getting into that environment now where the Treasury or the Federal Reserve may need to start the break the glass plan. We'll talk a little bit about that. Enjoy your day, everybody.